In our previous video on pricing equity, we talk about the dividend discount model and how you might be able to place an intrinsic value on a given stock. So let's talk about another formula that can complement this, called the price to earnings ratio.
Hi, I'm Linda and welcome to Life of the Big Four, where we give career, life, and study tips for a successful and prosperous business career.
The price to earnings ratio is stock price divided by earnings per share, or diluted EPS if available. And what you're looking for here is to see if you can identify a constant downward trend on this number. For instance, let's say a company is trading at $50 with EPS of 2.5. So 50 divided by 2.5 gives me a price to earnings ratio of 20. Now let's say that I look into some data from the past few years and I notice that their earnings per share ratio has been consistently declining. This could be a good sign that this particular stock is undervalued. Think about it. If a company's EPS increases, this would decrease price to earnings ratio. And if the stock price decreases and EPS remains constant, it would also reduce price to earnings ratio. Both of these scenarios could indicate undervalue of stock. Now conversely, let's think about what would indicate overvalue of stock. If the stock price increases yet EPS remains the same, this could indicate that the price is inflated. Similarly, think about if EPS were to fall but stock price remains the same. This could potentially indicate that the price is overvalued. Bottom line is that this is a great formula to pair with the dividend discount model to figure out what stocks you should invest in.